Most families buy the wrong life insurance, and it quietly costs them hundreds and thousands of dollars. If you have kids, debt, or anyone who depends on your income, life insurance feels like a must-do decision. But here's the problem. The insurance industry throws a dozen confusing options at you, uses fancy words, and somehow makes a simple idea feel like rocket science. Term life, whole life, universal life, cash value, tax-free growth. It all sounds smart, sounds safe, sounds all really expensive. In this video, I'm going to break down what term life and whole life actually are, why one of them usually makes more sense for regular families, and the exact situations where the other one might actually be worth it. By the end, you'll know which one fits your life and which one you should probably walk away from. Let's start with the simple truth that almost no one tells you straight. Life insurance is not for you. It's for the people who depend on you. That mindset alone changes everything. If you didn't wake up tomorrow, who would struggle financially? Your spouse, your kids, your parents, someone paying off a house or loans with your income? That's the reason life insurance exists. Not as an investment, not as a savings account, not as a magic tax trick. Protection comes first. Now, let's talk about term life insurance in plain English. Term life is temporary coverage. You pick a time period, usually 10, 20, or 30 years. If you pass away during that time, your family gets paid. If you don't, the policy ends. That's it. No tricks. Think of it like renting an apartment. You pay for protection while you need it. When the lease is over, you move on. Most families need protection during very specific years. When kids are young, when you have a mortgage, when savings are low, when income matters the most. That is exactly what term life is built for. Here's why term life is powerful. It's cheap compared to permanent insurance. You can get a large amount of coverage. It is simple to understand. It does one job and it does it very well. For example, a healthy 30-year-old parent might get a 20-year term life insurance policy for $500,000 and pay maybe $20 to $30 a month. That is real coverage for real risk at a price most families can handle. Now imagine trying to do that with whole life insurance. The same coverage could easily cost you $300 to $500 a month. The difference matters because money is not unlimited. Every dollar you put into insurance is a dollar you cannot put into food, rent, education, emergency, savings, or investing. This is why many families get trapped. They are told, yes, it costs more, but whole life builds cash value. It's like a forced savings. It's tax advantaged. It lasts forever. All of that sounds good, but let's slow down. Whole life insurance is permanent. It covers you for your entire life as long as you keep paying. Part of your premium goes to insurance and the other part goes into cash value inside the policy. That cash value grows slowly over time and you can borrow against it. This is where things get a little messy. Because now life insurance is no longer just insurance, it becomes a hybrid product. Part protection, part savings, part investment. And hybrids are rarely great at any one thing. Don't get me wrong, whole life insurance has some real features. It is not a scam. Let's talk about the cash value part because this is where the biggest confusion lives. When you pay into a whole life policy, the cash value does not grow fast in the early years. In fact, in the first several years, your cash value is usually far less than what you paid in. Why? It's usually because premiums are used to upkeep the policy in the early years. This means if you cancel early, you often lose your money. This is a huge deal that many people only realize when it's too late. Now, yes, over decades, the cash value can grow. It can grow tax deferred, meaning you don't get taxed on the earnings. And loans from it can also be tax-free if done correctly. But here's the honest question. Do most families need an expensive life insurance product to save money? Or would they be better off buying something cheap like term life insurance and investing in the difference? This is the core of the debate. Imagine if you buy a life insurance policy for $30 a month instead of a whole life policy for $400 a month. That's a $370 difference. If you invest the difference into simple investments over 20 to 30 years, the numbers often beat whole life insurance by a wide margin. Not always, but often, but it could be used as a great tool for someone who has a hard time saving. Although permanent life insurance is more expensive, it can be structured in a way that can be more affordable for most people. If a voluntary retirement plan hasn't worked out for you, like a 401k or a Roth IRA, this could be a great way to force yourself to save while also providing protection for your family through the life insurance aspect of it. Now, with term life insurance, you do have a little bit more flexibility. If your income drops, you can adjust. If your goals change, you can adapt. You are not tied to a high premium for decades. Most families need flexibility more than complexity. That being said, a permanent life insurance policy can also provide a lot of flexibility, but it's most likely going to take about 10 to 20 years to really get there. Now, let's talk about the different types of permanent life insurance briefly, because people hear these names all the time and they feel overwhelmed. Whole life, universal life, indexed universal life, final expense, or funeral policies. They all have different rules, but they share one thing. They are all permanent life insurance policies. We'll start with whole life insurance. So whole life insurance, you pay a premium and you get a face amount or death benefit. As long as you pay the premium, the policy will stay in force for the rest of your life. They are not usually very flexible. So as soon as you stop paying the premium, the policy will cancel. If you have any cash value in it, you will most likely be paid the cash value in it. But in most cases, it's going to be less than what you actually paid into it, especially if it's in the early years of the policy. Now, with universal life policies, similar to whole life policies, that as long as you pay your premium, the policy stays in force. The biggest difference is that these type of policies have that investment feature that we talked about earlier. Now, these policies often do have a lot more flexibility. You can put more money into them. You can put a little bit less money into them. The premium is not usually fixed. Now, indexed universal life is usually tied to an index, usually the S&P 500. These policies are probably the ones you've heard the most about, where the rich put a lot of money into it, they make a lot of money, and they get all the tax-free benefits of it. Now, some of that is true, but you don't need to be rich to really take advantage of them. Again, a structured universal life policy can be affordable for most people. The great thing about universal life policies is that they are considered safe investments. There's something called a floor tied into the policy. What that means is if there is a down market, the floor will prevent you from losing any money. This is usually 0, 1%, a very low percentage, but basically meaning that you're almost guaranteed not to lose money in these investments. However, there's also something called a ceiling, meaning the most amount of money you can make in these universal life policies. For example, if the market was up 20% and you have a ceiling of 12%, the most you can make is only 12% on your investment that year. So these policies can be really great if you're looking for something safe, because on a down market, you won't lose any money necessarily, but in an up market, you won't be able to take full potential of all the gains. There are other universal life policies called variable policies that can make potentially more money, but again, can potentially lose more money, but we won't get into that right now. And finally, final expense or funeral policies. So final expense policies kind of make more sense for older individuals who may not be the healthiest. It's usually purchased to take care of funeral costs or final expenses or deaths. Although all these permanent life insurance policies are a little bit more expensive, I wouldn't say that they're unaffordable for most people. Again, it just depends on how you structure the life insurance policy itself. Now, the biggest challenge is not choosing between term and whole life. People are scared of dying, scared of leaving their family in trouble, scared of taxes, scared of missing out. When fear meets confusing products, bad decisions can happen. Many families end up uninsured, and because they never chose on a life insurance policy, many families have to go to GoFundMe. Honestly, the best life insurance you can have is the one that's already in force, regardless of whether it's term or whole life insurance. Every situation and every family is going to be different. Insurance is about replacing income, not feelings, unfortunately. That could mean getting a term policy or getting a permanent life insurance policy, or you can actually get a combination of both. Regardless, make sure it's something that's right for you, your family, and your budget. Let's talk a little bit more about permanent life insurance and where it makes sense. So let's say you have maxed out all your other investment options and want another tax tool. You have a very high income and a very long time horizon. You need permanent coverage for estate planning. You want guaranteed insurance no matter what happens to your health. These are all great reasons on why permanent life insurance may just make more sense for you. Now, what if I told you that there is a in-between type policy? a policy that you pay into, and if you do not use it, you actually get your money back. These are what are called return of premium term life policies. So for example, if you have a 10, 15, 20-year term policy that you paid into, and at the end of the term, you are still alive, you will get all your premium back plus a percentage. Usually it's about 10%. These policies are a little bit more expensive, but it's kind of a nice thing to know that if you do not use it, you're going to get all your money back and then some. Now, this might be a lot of information, but everybody's going to have a slightly different situation that's going to have a need for a slightly different policy. It just all depends. How big is your family? How big is your debt? Are you disciplined with money? Do you want to invest? Do you want to find a different avenue to grow your money? Every policy is going to have a different need for every family. So in conclusion, what policy makes the most sense for you? Honestly, it all depends again. But if you're ever sitting down with an agent and you feel like you're being sold something, you probably want to talk to another agent or get a second opinion. When purchasing a life policy, you shouldn't feel like you're being sold something. You should feel like you are purchasing something for the needs you're trying to fulfill. I hope you found this helpful. And if you did, please be sure to like, share, and subscribe. Follow us on social media. And if you have any further questions, feel free to send us a DM.